Video, make sure that you are subscribed, make sure that you follow, and I look forward to seeing you on those two platforms. For much of the past year, the dominant official mood coming from the White House about the U.S. economy has been one of confidence, even optimism, I would say. Markets are near record highs, and the prevailing assumption is that next year will look much like this one. Risks are manageable and no major disruptions are expected. That's the official version. But history should make us deeply uncomfortable. With that level of certainty, and with that level of confidence, Desmond Lachman, who is a former deputy director at the International Monetary Fund, published a very interesting article that I would love to discuss with you today. He is convinced that the atmosphere today is eerily similar to early 2008, when consensus opinion insisted that the economy was fundamentally sound. Even as warning signs were flashing in plain sight, back then the risks were just dismissed as isolated and manageable, and we all know how that ended. Today there are so many red flags, and I keep mentioning them in my video, so many red flags that we can hardly count them. However, everyone is ignoring them, and we're just sleepwalking into another financial crisis. Mr. Lachman here says the risks are different today, but they're no less serious. Record public debt, open political attacks on central bank independence, the steady breakdown of the global trade system, and bubble-like conditions in both equity and private credit markets are all being brushed aside in favor of a comforting narrative of continued growth. And if history is any guide, that complacency may prove to be a costly mistake. What one of the most alarming blind spots in today's consensus that he discusses in this article is the state of the U.S. public finances, and we will begin with this. The International Monetary Fund is warning that America's budget deficit will hover around 7% of GDP for the foreseeable future. Public debt is projected to climb to roughly 128% of GDP by the end of this decade. This is well above levels seen after World War II, believe it or not, and these levels are more commonly associated with countries like Greece and Italy. However, these numbers barely register in market commentary or political debate. We don't really hear about them at all. And why would that be? That is a very important question to ask. What makes this situation particularly dangerous is how dependent the United States has become on foreign investors. Foreigners currently hold about $8.5 trillion in U.S. Treasury bonds, which is roughly 30% of the total outstanding. It is a big part. That means the United States must continually persuade global investors that it will responsibly service its debt, that it will roll over maturing bonds, and that it will manage its finances prudently. Well, that would be something new, wouldn't it, with annual budget deficits approaching $2 trillion? The confidence is not optional. It is essential, but how long can we fool the global majority? Even the global majority now looks at the United States and realizes that behind the glossy veneer, things are starting to look risky. They're starting to look less comforting. Well, the author of this article is convinced that there is even a bigger threat associated with political pressure on the Federal Reserve. If investors feel the Fed is being pressured into tolerating higher inflation just so that the government can inflate away its debt, they will demand higher returns on long-term bonds. The result would be devastating. The result would be a spike in borrowing costs, not just in the United States, but across global financial markets. Compounding this risk that I just mentioned, that I just walked you through, is what increasingly looks like a new asset bubble. Back in 2008, the epicenter was housing. Of course, well, today it is artificial intelligence. You may recall that I recently uploaded 2 videos about the AI bubble, those valuations that are not based in reality. AI investment has driven equity valuations to levels reminiscent of the dot-com era. Only a handful of tech giants tied to AI now represent more than a third of the entire index. When institutions like the Bank for International Settlements, along with investors such as Warren Buffett and Ray Dalio, start issuing warnings, it is worth paying attention. Wouldn't you say, needless to say, in an environment like this, higher long-term interest rates would be toxic? They could puncture the AI bubble. They could trigger a sharp decline in equity prices, and they will slam investment spending. Combined with a sudden loss of household wealth, that shock could easily push the economy into recession. or something much worse. And yet, given large deficits and political interference with monetary policy, a rise in long-term rates is not a remote possibility. Not anymore, it is now a real and growing risk. So hopefully, this puts current events and recent developments in perspective. For you, what I really appreciated about this particular article is that it didn't go into too much detail, but it kept the discussion high level enough to see the whole forest. If you will, I briefly touched upon the AI bubble in this video, and this is a very important topic, because with trillions of dollars invested in anything with an AI sticker on it effectively, the risks have escalated, to the point that a downturn in this industry and the AI industry may lead to broader economy-wide crisis. There are 2 videos that I uploaded recently with more details, and a quite detailed discussion on this, so I don't want to repeat myself. Check them out next. If you would like to gain a deeper understanding of the growing threats associated with the AI bubble, stay tuned. I will keep you updated here on YouTube and over on my Substack and Patreon as well. I will continue this discussion, as you know. I'm very focused on the economics, and this is something that I do a lot of research on. Thank you so much for watching. Thank you for joining me. Support my work. I appreciate every single one of you who has become a paid subscriber. Thank you so much otherwise. Like, subscribe, and share, and I will see you back here tomorrow. Take care.